like blew wide open. I saw 10 to 15% more. And I said, really?
Hi, Scott. Well, look, that doesn't necessarily have to happen in a straight line, but the movement over the last couple of days has certainly been very constructive. We've seen, over 7-to-1 advanced declines today. We had almost 8 sectors that were up more than 3% on an equal weighted basis today. So that's very strong movement at a time when indices had gotten quite compressed to the downside. And we saw only about 2% of all S&P issues above their 20 and 50-day moving averages. And so coming into this week, we had a combination of not only some cycles that were due to turn up, but sentiment had gotten very negative, breadth had gotten very compressed, and S&P had pulled right back down to levels that you and I talked about right near June lows. And yes, they were undercut by 1 day, but generally most sectors and indices held and now have started to bounce. So I do expect that we'll see some follow through between now and probably the middle part of December. But I think it's going to be a 2 steps forward, 1 step back. We've already moved 5% very quickly. Any sort of pullback, in my view, likely is going to be a chance to buy. And a lot of this has to do with interest rates and the dollar finally starting to show some evidence of weakness.
Haven't we seen this movie before? That's all I can think of when we see a really powerful move ahead of a CPI print. Makes me nervous for obvious reasons. I'm sure our viewers who are listening to you are thinking the same thing.
Well, there are some things you can put together that do make it correct to try to fight a downtrend like we're seeing. And some of those are just sentiment levels when you get so compressed and then you see a big upward thrust and breadth to the upside. So some of that we did see in June. And yes, that move lasted a short time and we had a little bit of consolidation, but then we continued higher in the middle part of August and then also higher into September. And so look, I mean, markets don't move in a straight line. You and I know this. This is still part of a cyclical bear market, which I view as part of a secular bull. But, in general, people are too bearish. And, we've seen some evidence now that people are being caught off guard at a time when healthcare is working very, very well. The second largest sector as part of the S&P doing extraordinarily well. Consumer discretionary on an equal weighted basis has beaten staples. So a lot of moving parts are there under the hood that many people really aren't paying attention to.
You say it's a cyclical bear still inside of a secular bull. What ends the bear market? Is it the Fed? That's the ultimate thing that has to happen to say, okay, bear market's dead?
Well, some of it has to do with time and also price. If it were to end now, it would be one of the shortest bear markets on record. I don't completely think that it's possible to rule out that we just move straight to highs, but I think that for S&P in pure price terms, if we got over 4,200, for me, that would be extremely important. That's a 50% range of the whole high to low range is a huge downtrend from January that extends down. So for me, that's important. A lot of it's going to be we're likely to rally up sharply, then we'll give a little bit back, and then we'll continue up. But the time between now and December historically is quite constructive. It's a midterm election year. Octobers tend to be much better in midterms, averaging about 1% versus 0.3%. And the fact that we were so negative heading into this, we started to see these breadth divergences, a lot of these things that make viewers' eyes roll over, but these were in place. And now we're starting to show evidence of turning up, while at a time when really nobody wants to believe it or wondering if they should chase. So, I'm constructive between now and December. I'm hoping to get pullbacks to buy into, honestly.
What leads us there? What gets us to your promised land?
Well, technology and a continued rolling over in treasury yields, which I think will be good for growth. And also, from a non-technical perspective, some evidence of inflation starting to roll off. But, I'll leave that to those that are smarter than me in economics. Bottom line is that, technically we've seen the first part of this bottoming process. I think it's very constructive and, I'm hoping we can build on it. But we certainly have some of the pieces in motion with regards to healthcare, technology with a very good comeback in recent days. Discretionary has outperformed on an equal weighted basis over the last month, over the last week. I mean, these are all, financials, industrials starting to do well. So there's more to it than just looking at the S&P itself when you analyze, as I said, under the hood, what's working.
Yeah, I hear you. All right, we'll keep watching under the hood, and we'll see where this goes. And I'm sure we'll have you back. Mark, thank you. That's Mark Newton from Fundstrat joining us. Up next, go.